Welcome to the daily update, where I'll go over the action in the market for Wednesday, May 8th, and we'll see how things look for Thursday, May 9th. A really quiet day, a narrow range, mixed market. The Dow was actually up. The other indexes were under a bit of pressure. We're still looking positive in the short and intermediate term, but the market is looking kind of tired right now, and it may continue to do so. Now, one of the bigger reports of this week, anyway, are going to be the weekless jobless claims and the continuing claims. Usually, it's just, as far as I see things, it's just another thing that comes out every week, but it's one of the more important ones this week, especially on the heels of the employment situation report that we got last Friday. But we're still hanging in there. We're not seeing an awful lot of selling into strength, and things are holding up above the 50-day moving average. We're still fighting with that 5,200 level. Now, we didn't fight it in Wednesday's session. We hit it on Tuesday and then came back down. At some point, if we're going to turn positive again, we're going to need to break through that 5,200 level. So let's go back and talk about what happened. Right at the open, we had a gap lower open. The futures ended up being negative, and we gapped lower. And it was like, okay, let's see. Are we going to have any kind of a significant down day? No. We opened right at S2 at 51.68, and then we climbed above S1 at 51.78. We got back up to the unchanged level, which ends up being resistance on a down day. And that was right about at the daily pivot at 51.89. Then we declined back down to S1, and then we bounced back up to the unchanged level again, and we closed pretty much unchanged for the day. On a percentage basis, we were unchanged. We were down just a few ticks as far as price. So we were unchanged that way, and we were below average with volume. And we've been seeing that so far this week, below average volume days as the market seems to be improving. We had the nice run up on Friday, and then Monday was pretty good, but that was below average. And we've been below average so far for the last two trading sessions as well. So we are looking more positive still. We're still hanging in there. We're watching a lot of the ratios to see, are we switching back over to more of a growth stance, or are we going to switch over to more of a defensive stance? And it's still inflation and interest rates. That's the main thing that the markets are dealing with right now. We want to keep an eye on all the different geopolitical events, but they don't seem to be really having an impact on the market, at least directly, to the point where it's becoming headline news. And some comments. It was a very narrow range day. We still have our same list of extreme positive readings in the short term. Again, as I always say, there's two ways to take this. We are overextended to the upside and due for a pullback, or as long as we stay up in this area, that's also showing good momentum. This includes the Stochc RSI, the Williams Percent R, the CCI 14 and 20, as well as the stochastics. Intermediate term, we're still extreme with the CMB composite. In the long term, the 150 and 200 period moving averages are still extreme. This is the scenario that the market seems to be working with right now, that the Fed's probably going to leave rates unchanged because inflation has been really stubborn at coming back down. We're not sure if they're going to have any rate cuts. Now, there's still a lot of folks out there, a lot of banks and a lot of folks in the financial community that are expecting rate cuts in 2024. They don't seem to be really concerned about that right now. But if time keeps dragging on and it looks less and less likely that there are going to be rate cuts, that could have a real impact. And then the Fed has also not officially come out and said that they're decreasing quantitative tapering, which tends to be more market friendly. And the dollar was up. Interest rates were also up. We were at 4.49%, where we had been at 4.46% for the 10-year yield. We're still inverted with the yield curves. And I don't know what's going on with the CNN Fear Greed Index. We're not, I mean, we had an unchanged day, so that's not necessarily a surprise. But you have other sentiment indicators which are improving. This one's just kind of stuck on negative right now, coming in at 39. We are now in a non-trending environment. The ADX is below its moving average, and it's dropped below 20, both in the short term and in the intermediate term. It is positive, though, because the green line is on top. And I've changed our bias to mixed just because it was an unchanged day, but I'm still keeping our momentum over the last number of days at positive. We had the weekly MBA mortgage applications index. It was up 2.6%. Last week it was down 2.3%. Wholesale inventories came in as expected, being down 0.4%. Last time it was up 0.2%. Not real influential economic reports. And the only chart I'll show you here is the weekly mortgage applications, where it was up. We'd seen 2 weeks of declines. Now we're seeing that coming back up just a little bit there. And then some Isabel Net block charts, the annual percent change in share buybacks against the S&P 500. Here in black is just the S&P, and then these are the buybacks. And you can kind of line this up and see when there are a lot of buybacks. That's usually when we're going up. Now, you would think stocks might come in and actually buy when it's at a lower price, but it tends to not really work that way. They like to buy into strength and then just hold it. And if anything, sometimes possibly even sell into weakness, but that's usually not what they do. They usually buy back their own shares. And then the markets are still pricing in rate cuts in 2024, and it's 40 basis points. Now, we usually get these in 25 basis point increments, but looking at the chart where here's where we're at right now, and they see rates actually coming down, and we'll be at 4.4% by the end of December 2025. So that's still looking out a year, but that's what the market is still anticipating and figuring something like that is going to happen. Then looking at the 3 months earnings revision ratio, it's actually showing some improvement. Way over on the right-hand side, it's coming back up. So as earnings are being revised, they are looking better according to this chart. And then the Fed, and I don't really like these pushed forward type charts. I know they have their use, but it's like you just kind of look and match it up. You're trying to take data and match it to a scenario instead of just always letting the data speak for itself. But this is push forward 25 months. Why didn't they push it forward 24 months? That would be 2 years. And then the 3 month average of the VIX, just to show you the connection between the two. That as the Fed funds are going up, which they've been doing over here, and then here's the VIX showing the fear and greed over a longer period of time. Are we going to see this go back up to kind of match where the Fed funds are at right now? Then the economic surprise, they call this a map. This is a little different look of a chart that I showed very recently, where we're coming down. The economic surprises means that we're coming in weaker than expected lately with the economic reports. And that's been giving some support to the market because when they come in stronger than expected, especially things like CPI, PPI, GDP, things like that, not so much GDP, but with CPI and PPI, that is inflationary. And that has been really spooking the markets. Didn't find anything on Twitter. Here's our cycles chart. Just wondering if we're still kind of chopping around in the upward move of these particular cycles. Here's our intraday chart where most of the move would, on a percentage basis, happened right at the open, where we opened right down here at just about S2. We came back up to S1. We got back up to the unchanged level, the daily pivot. That acted as overhead resistance. We came all the way back down to S1. We came back up to the unchanged level and then just drifted off going into the close. Here's our intraday chart, not really showing anything all that drastic. We're still seeing where growth is outperforming value. The blue line's above the red line on this intraday chart. We saw a decline with S&P growth of value. So it's been improving, but now it's kind of trailing off a little bit. We want to see this continue to go up if we're going to turn more positive. Our end of day charts, growth was down with the large caps where it was up with value. It was down more with the mid caps and down with the small caps where it was up with value for the small caps. So our end of day charts not really showing any improvement. In fact, they're falling down a little bit here. Small cap growth of value did decline back down to the 200-day moving average. Mid cap growth of value also declining below its 200-day moving average. when we measure this ratio, and we declined with S&P growth to value on the end of day chart. Ticked down just a little bit with the growth to value that we use with these ETFs. And discretionary to staples also did really tick down, not really showing much improvement there. Large cap growth, we're still above the 50-day moving average. We were down just fractionally, 0.16%. The Wilshire also declined just a little bit, but still above its 50-day moving average. Here's our trend where we're falling below 20 now with the intermediate term ADX, the average directional movement. The green line is turning down, but it's still on top. So we would default to positive. But if we see a solid up day and the green line going back up, then we would want to see the ADX turn and go back above 20, above its moving average to show that it's a strengthening trend. We're seeing that same thing here with the short-term chart. Volume has been dropping off over the last number of trading sessions. Here's sentiment. We did get an updated reading. We're at 2.67 for investors' intelligence. That's more middle. We're not really showing an extreme reading currently. The VIX is continuing to decline. We were down with the line chart, and we're also down with the bar chart. We ticked back up just a little bit with the VIX of the VIX, measuring the volatility of the VIX, which also measures volatility. I know that's really crazy, but this is ticking back up just a little bit with the bar chart as well as the line chart. The momentum of the VIX still continues to be down. These were not updated, so I can't really update those things. We're also declining here with the volatility risk premium, showing that there's not a lot of volatility according to this indicator. We ticked up a little bit with this fear gauge, where we continue to tick down with this other fear gauge. We're still hanging in there with the advanced decline line based on price. We're flat, a little more flat based on volume, up just a little bit based on price. This is still holding up for right now. We saw a decrease in the new highs with such a narrow range day. We're still looking okay with our 5 period and our 10 period, even though the 5 period is starting to roll over slightly. And here's another look at this as well. This is more longer term. It goes back and just shows what the market was doing, and then the new highs versus the new lows. I won't go through all of this. You might just want to pause and look at this to see that it really does have an impact. That's why I watch new highs and new lows so carefully and really put an emphasis on them. We're still positive with the advanced decline ratio. We're still going up slightly with the accumulation distribution. So that's somewhat positive. But we just tick, you can't even hardly see it. There's even a smaller green blip with the Chaikin money flow. So slightly positive there. We're positive with the Chaikin oscillator. We tick down just a little bit with the cumulative NYSE advanced decline line, and just a little bit of a tick lower with our regular advanced decline line, a little bit of a rollover here as well. So not really any damage was done internally for the market. We're still going up with the common stock based on price. We're ticking down with a little bit based on volume. We're still positive with the NYSE new highs minus the new lows. And our cumulative advanced decline line for the S&P, we're still looking okay based on price as well as volume. We're still above the moving averages with the NYSE common stock, S&P mid caps, and small caps when we look at our advanced decline line studies. Here's our daily chart. Nothing really was decided in Wednesday's session. The Stochc RSI is still extreme positive. The Williams percent are, the CCI 14, and the CCI 20. We're watching the 20-period moving average just in case we see more weakness. Are we going to come down, and will one of these lines provide support? Also, we're still looking better here with our double and triple exponential moving average based on 20 periods. We're above the lines, and even though we declined, this is showing an improvement in the short term. We rolled over just a little bit with our 20, 50, and even the 200-period moving average study. We're still looking positive with the Force Index, even though it declined slightly. This short-term stochastics are extreme positive, as are the intermediate term. We're crossing above the midpoint with our longer-term stochastics. So this chart is still improving. We're still in the lower end of the +2 channel with our standard deviations chart. The balance of powers continuing to be positive. We're still showing the brown bars with the go, no-go system as we try to switch from negative and possibly back over to positive. Our highest high value, we're still right up at the blue line. The blue line's starting to go back up and we're above the midpoint, and the midpoint is advancing now. The TTM squeeze is continuing to be positive. Our 50-period double and triple exponential moving average, we're still above both lines, and so they are starting to turn back up. Here's the CMB composite where we're above this black line. This is the second day now we've been extreme positive with this. We want to keep an eye on the 50-period moving averages. We're still above both right now. If we see some weakness, will one or both of these provide some kind of support or at least some kind of a slowdown if we continue to fall? The ease of movement continues to be positive. We're showing some improvement here with the Erin indicator, but it's not really moving all that much. It's still negative. The McClellan oscillator for the S&P did tick down, but we're still above zero. So we're going up based on price and volume with the summation index. And the NYSE McClellan oscillator did decline, but still above zero. So with the summation index for the NYSE, we are advancing based on price and volume. Swenlin trading oscillator still looking positive, both based on price and volume. And our oscillators, this slowdown has given them a bit of a chance to catch up. And so we're pretty much turning positive now. Here's the PMO crossing above its moving average. We're advancing based on price and volume. So with our studies, the PMOs that are rising, it came down just a little bit, but it has been improving. The buy signals are still going up, and we're slowly starting to come up with the percent of PMOs that are above zero. We're still positive with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR. We're actually positive now with the slope oscillator and the MACDs crossing above the 0 point. So that's positive. So all of these now, we're seeing a little bit of a lag here with the tricks, but it's starting to cross its moving average. So now we're seeing more across the board positive momentum, both in the short, intermediate, and long term. And we want to keep an eye on all these different moving averages to see if they provide support if we have some weakness. The bullish percent index continues to go up, and that's rather encouraging. We're above 50 and advancing, so that's positive. We're going back up with the NYSE bullish percent index. We ticked down just a little bit, and we're still just under 50 with the NASDAQ 100 bullish percent index. We're still positive with the money flow, and we're positive with the ultimate oscillator. We're positive with the vortex. We're looking a little better with the RSI 14 and the RSI 9. On balance volume, it came down, but we're still above the moving average. And we're looking better here with the stocks above their 20-period moving averages. We're above 50 and advancing. And here's another study. We never did get up to the 70 level, at least yet. Now we'll see. If we do have a good solid update, we'll see if we were able to break through that. The 50 period ticked down just a little bit, but we're still above 50 here with our 50. Can I say 50 enough in one sentence? With our 50 period simple moving average study. And we're pretty much flat with the 100 period moving average study and actually ticked down with the 200. The Copic curve is still positive. The Sean trend meter is showing some improvement here, but did tick back slightly. And we're still at the upper end of this Ichimoku cloud. And I wanted to include the standard deviation. This is starting to kick into gear a little bit, showing that we've moved up pretty quickly. This goes back over the last 10 periods, and it doesn't measure direction. It just measures speed. And this just shows that we were going up pretty quickly, and that's probably why the market's a little tired right now. The Pring bottom fisher still generated a recent buy signal, and we're waiting to see if what the mass index will do. When it crosses back down below the red dashed line, that's when a trigger is signaled, and it's looking for a reverse of whatever's happening. Sometimes that gives us a really good signal. Other times it's not been a good signal. Our different charts, we're still positive with the Heiken Ashi, the Kigi, the Renko, and the 3-line break. We're still above this R1 level at about 5110 to 5111, so that support level continues to hold. We're still looking extreme with the 150 and 200 period moving average studies. We're positive across the board with the Keller market model, and we're positive in the short term with bonds based on price. We're still negative in the intermediate and long term. Commodities are negative in the short term. No change on the decision point scorecard. Saw more blue than we did red. here. Nothing really that impacted the S&P, but we saw some discretionary. The BPI went above 50. That could be encouraging. But staples, the fact that they're doing really well, that's what's dragging down discretionary to a degree. The financial sector also showing some improvement there. And utilities are just getting a fire under them these days. And here's our sectors where we had utilities being the strongest sector of the day, and then the financials, tech was up. Then we had real estate, which is just getting spanked every day. It seems like not every day, but and discretionary, which ended up being down. So again, I don't want to try to read too much into these daily versions of the sectors. I like to look at them a little bit more spread out over a period of time because any sector can have a great day, but we want to see more consistency to things here. The equal weight, we're still looking okay, both with the S&P and the red line, which is the S&P equal weight index. We were up slightly with the ratio showing the S&P to S&P equal weight. We ticked up, just showing the mega caps held up a teeny tiny little bit better. The Dow is one of the more stronger indexes where it's above its 50-day moving average, and this is mainly earnings related. And the diamonds continue to be positive for the Elders Impulse system. We're still just coming back down underneath this R1 level. So we do have overhead resistance for the NASDAQ. We never did get up to this R1 level with the NASDAQ 100, but we're still above the 50-day moving average. We're still positive with the Elders Impulse system for the QQQs. We're looking more positive now with the momentum of the NASDAQ 100. We're still above all the moving averages with the QQQs. Small caps ended up being down, just coming down a little bit more into their sideways range. We switched over to neutral after being positive for the small caps with the Elders Impulse system. We're still above the 50-day moving average with the Russell 2000 small caps, turning down, but still above 50 with the RSI. Longer term trend is still positive, and the momentum continues to be positive. The mid caps are still above their 50-day moving average. And we're still positive with the Elders Impulse system for the mid caps. Apple was up a tiny bit. It's still above its 200-day moving average, but it's in a longer-term downtrend. Tesla was down and starting to drop down below its 50-day moving average and also in a downtrend. Nvidia was down fractionally, but still above its 50-day moving average. Microsoft was up a little bit, still having a hard time breaking through its 50-day moving average. Meta was up almost 1% and still trying to make a comeback to its 50-day moving average. And Amazon ended up being down. It's really having a hard time breaking out and setting any kind of a new all-time high, at least yet. Google was down over 1% after it's been trying to bounce back up lately. The FANG index was down fractionally, but still above its 50-day moving average. The financial sector was up and above its 50-day moving average. We're ticking back up just a little bit with our staples to tech ratio. And that's to be expected. We don't go straight up or straight down. If we break above this moving average and start to turn up with this ratio, that's when we get concerned. If we can resume going down, that would be more positive for the tech sector. That means it's outperforming. The dollar ended up being up. We're back up into the mid 105 range now. And looking at the S&P with international stocks, the short-term correlation is still getting stronger, pretty much flat to slightly declining with the longer-term correlation. We were down fractionally with the total U.S. stock ETF, but we're still above the 50-day moving average. We were up with the 10-year yield. We were down with the 10-year based on price. And we want to keep an eye on these different ratios. This is bonds to stocks. When this is going down, that means bonds are underperforming, and this is continuing to decline. And we look at the broad market, the S&P 1500 with bonds, this is still going up just fractionally, but it's above the rainbow. And our other broad market measure, it's also moving up above the rainbow. That could be positive for stocks. We're still looking okay here with the soft landing scenario. This ratio is coming back up out of the rainbow. And the tech sector is just barely peeking its head outside of the rainbow compared to bonds. The QQQs are a little bit above the rainbow compared to bonds. And just to keep an eye on what's going on in Europe, they had a pretty good day there. So the Eurozone compared to American bonds is showing some improvement that way. And then our growth to value ratios coming back down to the moving average with the Qs to S&P, still just showing weakness here with discretionary to the S&P turned down, but still above the moving average when we compare large cap growth to large cap value. So turning down, but still above the moving average with the large caps, seeing more weakness with the mid caps, and we fell below the moving average with the small caps. We're still looking okay here with our 10-day average of the S&P 500 highs minus the lows. We're still positive with our 19-day advanced decline ratio, both based on price and volume. We're still positive with the 5-period moving average of the highs minus the lows across the broad market. We're declining here, and this is putting a bit of pressure on the S&P. Utilities are just getting a fire right now, and so this ratio continues to go down. We want to see it to go up for it to be more positive, and we're coming back up. Excuse me here. Everything's fine before I start recording. I take a drink of water, I test my voice, and then I start talking, and it goes crazy. But we're ticking back up just a little bit here with our Staples to S&P ratio. We want to see this continue to go down to turn more positive. So what's our outlook for Thursday? We're still positive and above the 50-day simple moving average. I really haven't changed that in the last couple of days. We're going to get weekly jobless claims and existing claims. We want to keep just an open ear to what's going on geopolitically in case that can affect the market. And then on Friday, we'll get consumer sentiment. We're going to get the 30-year bond auction. Apparently, the 10-year didn't go all that well. That's why we didn't see an awful lot of change there, at least on a positive aspect for bonds. We'll see if the 30-year auction goes better in Thursday's session. Seasonality, we're negative with the Dow for May 9th. We're neutral to negative with the S&P. We're neutral to positive with the NASDAQ. So we run the whole gambit there. We do see a little bit of negative seasonality on the 7th trading day of the month, which will be May 9th. So we are coming down just a little bit here. Thursday is one of the more positive days of the week based on what happened in 2023. We do see some weakness throughout May, at least on an average basis. We also see that weakness based on the Stock Traders Almanac chart. And we're wondering if we're going to follow what happened in 2012. We did see some weakness in May before things started to look a little bit better. Also, the Carson chart shows this weakness in May. And here's a newer seasonal chart where we're kind of focused more. We're looking out a little further here. It just says the 3-month seasonality for the presidential election years goes back to 1928. It's the summer months that tend to do best. And then according to Tom Bowley, we're still in this weak time right now, and we will be until the 25th of May. So the warning signs. I don't know about the equity put call ratio. I'm assuming it's probably still going up, but I can't really update those charts. And the bullish percent index, because it's still below 50, even though it has been improving, it ticked down a little bit on Wednesday. We'll see if it can actually get back above 50. We still have a pretty long list of positive things. Our oscillators, the Swenlin trading oscillator, the parabolic SAR, the BPI, the ultimate oscillator, Chaikin money flow and oscillator, the money flow, the vortex, Copic curve, the momentum for the NASDAQ 100, and the financial sector. So our conclusion, we're still positive and above the 50-period simple moving average. Nothing has really changed there. In the short term, we have a longer list. We are extreme positive. Again, is that meaning that we're overextended and due for more of a pullback, or is that showing good momentum? Intermediate term, we're pretty much positive for right now, and we continue to be positive in the long term. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.